Coming in hot. Got a stack of papers from the IRS published in the Federal Register. Proposed rules for crypto. Are you safe? I've got the next 10 years worth of legal challenges ready against this regulation in my hands. Do you stay anonymous? Can you use crypto for money? Is stablecoins going to be allowed? Are NFTs going to get regulated? That is the question.
I do have, I guess, one question, and it's really, this is like on my regulation, I guess, bingo card. And it's if you like publish a smart contract, and let's say some of these regulations require you to implement some sort of control that doesn't exist. You don't have a way to go back and change these things. And it's kind of like, I want to say ex post facto is on your side. I wonder if any of those regulations would defy that.
So MiCA is one of the such regulations that requires you to have backdoors. And obviously, you don't have backdoors on things that you didn't put backdoors in the first place, right? And here's the rub. You always have a backdoor. So that is the centralization question. If you have a URL, you have a backdoor.
That sounds like exactly what they did with Tornado Cash. They were very strict on the URL versus the actual smart contract and its implications.
Yeah. I think that the people that are trying to do this crypto stuff are really leaving a lot on the table by not publishing on IPFS.
It sounds like the window of opportunity is closing for people to have the ability to publish smart contracts that aren't affected by these much more strict laws.
Yeah. Under MiCA, the time is ticking. This is the regulation, so there's a URL. And I'm just going to pull it up on the screen and then give you some things. So I've got it like color-coded and everything in my hands. And I will also be attending in person in Washington. I get 10 minutes on the stand. I'm actually going to make a pull request against this whole regulation. I've got actual, probably legal challenges on this. There's two main topics here. One of them is what is required for brokers. So if you're a broker, let's think of like a stockbroker, there's a rule, and basically they want to have a lot of transaction data getting reported to them. That's the first half of this. The second half of this is how is the basis going to work? You have a basis and you have a gross proceed, and that determines your gain or loss. But basically, what is your gains and losses for buying and selling crypto things? Were they going to exclude DeFi? Were they going to exclude stable coins? They didn't. Are they going to exclude NFTs? They didn't. And then they compare these regulations to the proposed regulations to the existing regulations for securities. One of the main motivations, as they're saying, is a lot of these security regulations were created back in the day. And back in the day, we had indicia because people were mailing things via mail. Indicia doesn't exist anymore. So you have to use IP addresses. And they're just saying, we're gonna start this basically from scratch to be parallel to securities regulations, but we're just gonna not make them comparable because this is the 21st century. They're comparing it to payment cards, like credit cards. And I actually went up and I looked at the regulation for payment cards. And so it's really simple. The payment cards is like this. So payment card, like we're talking about credit cards, right? Credit card, gift card, other things like that. And you put a bunch of money in a credit card, that doesn't get reported to the IRS. There's not under broker, not under 6050W, but under the payment transactions regulation, when you are a credit card processor and you write a check at the end of, over the weeks to the merchant, that is reported. You know how they report it? There's one number at the end of the year that they give the IRS, and they say, okay, this guy 037 sold a bunch of lemonade at his house, and he captured credit cards, and we sent him $75,000 in payments aggregate over the year. That's it. From various people to 037, dollar amount, 75K. That's what they report to the IRS. What do they want for crypto? They want a lot more than that. If you're doing payment processing for crypto, under these rules, you will not just disclose the total value that you capture for the merchant. You will disclose every line item of that payment. There's a problem. So I don't think the IRS needs line level detail of all payments, and they're treating crypto a lot differently than payment cards.
Was there any mention of like a quantity before reporting?
So they said we are considering to have a quantity. However, for reasons, so no, there's no threshold. They're not looking for any type of threshold. And they're saying that because there could be many, many transactions that might add up to some threshold. Some of the questions are, should we introduce a threshold? So the proposed regulation says no, but they're asking if there should be. And I don't think there should be a threshold at all because they shouldn't collect any of this stuff. There is no transaction that should be reported to the IRS simply as a fact of it being a transaction. There are already rules about reporting transactions over $10,000. These are Treasury regulations. The IRS has no business understanding transaction level data. This is actually one of my major complaints. I think I can stop this regulation as being illegal. What if you're using a crypto credit card to pay for an abortion? That's going to be my example. Using crypto payment card to pay for an abortion. Well, crypto payment cards, they look just like other payment cards. I mean, they think they have the Visa logo on them or MasterCard. You wouldn't know the difference. And you go pay for an abortion with this credit card. But guess what? Every single abortion will be tabulated and reported to the IRS. That breaks a lot of laws. Not only does it break HIPAA, because IRS has no business requesting every abortion that's run, there's also state laws. And how does a federal regulation get impacted by state laws? I've got a loophole for that. So I think this is going to be the undoing. I think that they're really aggressive for this payment level detail, and I'm actually happy to shut them down on that. That's my main complaint, and I've got plenty of other smaller complaints, but I think that complaint's large enough to actually stop the regulation. Now, there's some great stuff about this. There's actually great numbers in here. They're saying that, actually, let's guess. What do you think the IRS cited as the number of people using crypto in the United States?
If I had to guess, just a random number, definitely in the millions range.
The Treasury Department and the IRS estimate that 13 to 16 million customers will be impacted by these proposed regulations. 16 million people. Wow. I did not expect that. So IRS is saying that over 1 in 10 households in the US are using crypto. That's amazing. And now you can cite that. Because I'll tell you, there's not 16 million people on OpenSea. There's not 16 million on... They're saying not 16 million wallet addresses. They're saying 16 million taxpayers. Total estimated burden, they think it's going to cost $1 billion for us. Like the total price of all of the people reporting all the things will cost $1 billion. But they're also saying that there's a large gap of people not paying taxes, which they think is more than $1 billion. So, I mean, I have no comment on the size of these numbers, but it's nice that we can see the numbers and then we can quote them. For DeFi, so this new regulation from the IRS is saying that if you're doing DeFi, if you're allowing people to exchange crypto assets on your website, you just gotta, go get their social security number first and report that to the IRS. So I have no idea what Uniswap or Compound is going to do. Don't think I'll get a response from the people that I know because that's, you want to be real careful right now. This is rough. I mean, this basically shuts down DeFi. So DeFi getting shut down. Friends in Europe. I see in here they have explanation of who is required to file. You can be a European company serving Europeans and still have obligations under this law. Like, what? That's not how law works. Well, that's how the world works. So the IRS says, look, if you're going to be a European company and you're going to do business anywhere, well, some of the customers might be from the US. And if they are, we're expecting you to give us that data. In fact, even if they don't tell you where they're from, if their IP address is from the US or their address is in the US and they don't give you hard facts to the contrary, then you have to assume that they're US people, even if they're Europeans. Okay, so what happens here when you have to get IP addresses, but you're not allowed to get IP addresses under European law? So how does that work? I would call that a technical problem, but also a territorial problem. I mean, if you're a European exchange, do you really want the IRS telling you what you can't do with European customers? I mean, that's whack, right? I also see in here, there's just a general misunderstanding of how assets work. The understanding of the IRS is that each asset has an owner and therefore each asset has a private key. So they're just finding the public keys of the assets to figure out who is transferring to whom. I think that's a little wrong. It's technically wrong, right? Assets have owners, which are public addresses, and public addresses do not always have private keys. Public addresses could be smart contracts, which is a whole thing. And that kind of throws a wrench in it because what if there's multiple owners? What if there's a trust, a crypto trust? That's not even a thing that people are thinking about yet, but it's called safe now, Gnosis, safe, right? Those are my main complaints. I got to articulate all that. I'm going to write it up, get it in the comments. We've also got the NFT circulator. So I created a smart contract where you can send the NFT to yourself multiple times. Using the circulator may be a way to generate infinite tax returns. So if everybody just used the circulator, then this may require brokers to produce arbitrarily long lists of tax filings. So, terabyte, petabyte, exabyte. Do you need exabyte scale IRS filings? You can't move a dollar bill, a billion, trillion, quadrillion, right? You can't do that. You can't move a dollar bill a pentillion number of times. You can move a digital asset a pentillion number of times, and that requires a pentillion number of disclosures to the IRS. I'm looking at this from a lot of angles. So do you know what it costs to store an exabyte? It might cost more than $100 million, and it might hit the threshold where you require congressional overview of this regulation. So, when you got people like me reporting taxes, watch yourself. 39 questions here. A lot of them are great questions like, hey, if you're a broker and you're already reporting on stocks and you're also going to report on crypto too, do you think these rules are compatible? Do you think paying to have to do them separately? They also have a question, this was smart. If there's a decentralized, some type of a protocol or something, then under what extent should the governance token holders be treated as operators? The last thing I want to say here is that it's rough. Obviously, the IRS wants to tax this stuff, but there's a very unique situation here with crypto is that there's so many different types of assets, 9,000 different types of tokens. That's a problem, especially how do you compute the gains when you've got token A and you sell it for token B and you sell it back? Are you always looking at the market price? Are there market prices? Does the market price matter? There's actually a lot of illiquidity in a lot of these things. So for me, I think there needs to be round tripping. So if you have asset A and you sell it for asset B and you sell it back for asset A and you get a few more of them, the few more, that's the thing you need to be taxed on. So let's draw this out. Okay, you've got 100 beans sold for, now you got 25 chickens, and then it goes back into 120 beans. You should only get taxed on the plus 20 beans, right? You had 100 beans and you ended up with 120 beans. But actually the taxes that you will pay is based on the market price of the beans, which might not even be reliable. So that's a problem. This is something that we need to treat differently with crypto in terms of taxes. You gotta look at round trip on something, or maybe it's a wash. Maybe somehow this washes out or something like that. I'm gonna illustrate some of these points by also comparing to loyalty points programs. Credit card points, hotel points, travel points. A lot of loyalty points programs meet the definition of a digital asset. And the airlines and the credit card companies count as digital brokers, digital asset brokers. I'm sure nobody at the IRS was thinking about going after Chase and all the people that donate to ask them to report every single points transaction that you use on your airplane miles. However, the literal interpretation of these rules, those apply. They are stores of value run in a decentralized network because they're on multiple ledgers, because it could be on the credit card, but then it could be on the airline. And there's a federation of airlines that can share points. They can be exchanged for dollar things, and they can be traded to different people. They're not inside of one game. I mean, every criteria they have, this meets. And also, critically, the prices can go up and down. So according to this, if you get a credit card, if you do a credit card transaction and you receive points, well, that should be taxed, right? So you're taxed at however the market rate of points. But then if you trade those points to a flight, you could be taxed on the trading because the flights might be worth more than the credit card points. And then if you take it from American Airlines and you transfer it to British Airways, well, those are actually worth more or less, right? So then you could be getting a gain or a loss at that point. According to this regulation, all those credit card companies and airlines will be needing to report those transactions, and you'll need to be recognizing gains and losses every time you touch these points. And I want that. I want that to happen. If this is going to happen to crypto, then I want every one of these credit card companies and travel and booking, hotels, flights, I want every one of them to do this. All or nothing, right? We don't just pick on crypto. According to the very top of the rulemaking, they have motivations for these rules. We need to address the tax gap. So my comments will say, oh, well, the tax gap on crypto, they think is 50%. They think half the taxes are not being paid. What is the tax gap on people not paying credit card point taxes? 100%. Nobody pays taxes on their credit card points, right? So if they're going to go after crypto and they think 50% of people are already paying crypto, well, their rule doesn't meet the justification. The motivation and justification here is to address the tax gap. And the elephant in the room is credit card points. So these are the angles. This is me going to fight for you, right? This is me fighting for all of us people that are seeing the future. Because the motivation, the thing that they're not writing here is, we hate crypto, we don't want you to transact anything except USD, and whatever their motivation is. That is the motivation. So just write that. Just write, we hate crypto. We think that is reducing the legitimacy of the United States government. But if you're saying you're addressing the tax gap, well, go after credit card points. Case closed. Lawyers that are listening to this are like, that is not how law works. Well, guess what, bitches? I'm going to go on ChatGPT, and I'm going to be half a lawyer as you are, and we're going to get it through. We're going to make comments that sound like a smarter person wrote them than me, and we're going to present them. I'm going to be on there. I'm going to be on the stand. I'm going to be like, look, this is a scam, this is a scam, this is a scam. You got to send this back. Probably the end result is just delay the whole thing by a year. The really thing that I think, not just for crypto bro, not just for to help all the people that are using crypto. I don't think government deserves transaction level detail. That's where you hit me right here. I'm like, no, I'm gonna fight you on that. Taxes, I want taxes on crypto. I want them. I think they could be a little more delicate with this round tripping.
I actually wanted to ask, like, if I were to create a smart contract, right? I have like a faucet that just gives away coins for free, right? And there's scarcity, of course, obviously involved with it, right? I'm not going to make the faucet infinite. I'm going to just apply some scarcity to it. I'm not going to create the liquidity for it. But obviously other people out there, right, that can't necessarily, I guess, use the faucet to a certain extent, they're going to obviously look for other avenues of getting that same exact coin. Now, I don't provide the liquidity. They're going to go and, they might go on Uniswap. They might go to these other exchanges to get the same exact coin to use on the smart contract platform. But does that mean that I'm still governed to, for instance, collect everyone's SSNs on the platform? Because I'm not giving any sort of value to that coin whatsoever.
So luckily, there is a IRS definition of an airdrop. The recipient by a customer of digital assets from an airdrop does not constitute a sale under the proposed 6045.
Neba's airdrop, does that still count?
Their definition is simultaneous distribution of units of digital assets to the addresses of multiple taxpayers. Now, if that's the definition, this definition's in a pair of parentheses here. Does that mean that all you have to do to run a crypto exchange and avoid IRS regulation is just send one Satoshi back to the founder with every transaction? We're breaking the spirit of the regulation there, but that's what it says. But if your faucet is multiple distribution, then it looks like that meets the definition of an airdrop here.
Exactly. So even if, let's say, someone were to take that airdrop and create liquidity for it somewhere else, does that mean the source of that airdrop still has to collect, like certain information?
The thing that they're concerned about is the word sale. So when there's a sale, when there's an input and an output exchange, that's where they want the reporting, which makes sense. I get that.
It sounds like a lot of the regulations really does apply to like on and off ramp type platforms, because this regulation becomes ridiculous in my opinion when those types of platforms that only use gas to drive them have to then like do things like collect SSNs, because no one's going to give their social to like random sites that they just come across like that. It could be like maybe a little game or file storage or something like that. You don't see me giving my SSN to Dropbox. Like that's insane. Beyond the tax incentives, I still think the whole KYC thing is really ridiculous.